Today, we're going to be talking about Chapter 15, which covers basic accounting concepts, techniques, and conventions. Just really a general discussion around accounting. We have a lot of objectives to cover, but when we finish today's discussion, we will have read and interpreted basic financial statements. We will have analyzed typical business transactions using the balance sheet equation. We'll have distinguished between accrual basis of accounting and cash basis of accounting. We'll understand what it means to make adjustments to the accounts under accrual accounting, and it will explain the nature of dividends and retained earnings, and we'll select some items from a set of data and assemble them into a balance sheet and an income statement. We'll also distinguish between reporting of corporate owner's equity and the reporting of owner's equity for partnerships and sole proprietorships, each of which being different types of organizational structures. We'll explain the role of auditors in financial reporting and how accounting standards are set. We'll identify how the measurement principles of recognition, matching, and cost recovery and stable monetary unit affect financial reporting. We'll define some key terms like continuity, relevance, faithful representation, materiality, conservatism, and cost benefit, which is covered in Appendix 15A, and we'll use some T accounts to understand this idea of debits and credits and how they are used to record transactions. Accountants record the financial history of a company. You can use accounting information to assess the past financial performance of a company and to help predict its future performance. In addition to businesses, all kinds of organizations, those are government agencies, nonprofit organizations, and others, rely on accounting to gauge their progress. The accounting process begins by recording an organization's transactions. A transaction is any event that affects the financial position of an organization and requires recording. So many concepts, conventions, and rules determine what events the company records as accounting transactions and how accountants measure the financial impact of each transaction. As you learn about these concepts, conventions, and rules, you will also learn about financial statements, which are summaries of recorded accounting transactions. You might recall very early on we talked about financial statements, and the key financial statements being the income statement, the balance sheet, the statement of changes in stockholders' equity, and the statement of cash flows. And we talked that, well, financial accounting, different from managerial accounting, but financial accounting is the branch of accounting that deals with how transactions are reflected in financial statements versus what we're talking about and have been talking about this semester in managerial accounting, which is internally focused and deals with all of the different topics we've been talking about: absorption versus variable costing, management incentive structures, even formats of income statements between different costing methodologies. And so you kind of see that there are the differences between these focus of financial accounting and managerial accounting again. So managers, investors, and other interest groups often want the answers to two important questions about an organization. How well did the organization perform for a given period? Where does the organization stand financially at a given point? Accountants answer these questions with three major financial statements: the income statement, which we've looked at before, the statement of cash flows, which we've talked about and looked at before, and also these summarize two different aspects of performance over a period of time. So, and then the balance sheet, which we've looked at and talked about before, which shows the financial position at a point in time. And so here we talked about this idea of how accountants answer questions with these three major financial statements: income statement, statement of cash flows, and the balance sheet. And so again, what we're looking at are how the questions are answered that deal with how well did the organization perform and where does the organization stand now. The balance sheet, also called a statement of financial position, is a snapshot of the financial status of an organization at a specific point in time. It has two sections, assets and liabilities plus owner's equity or stockholders' equity. Assets are economic resources that a company owns and expects to provide future benefits. Liabilities are the entity's economic obligations to non-owners. Owner's equity is the excess of assets over the liabilities. So we can see that this accounting equation is assets equal liabilities plus owner's equity, and this is referred to throughout literature, business literature. It's either the accounting equation or the accounting identity, and it's the same, assets equal liabilities plus owner's equity. And again, we say assets are what? They are economic resources that a company owns and expects to provide future benefits. Liabilities, on the other hand, are economic obligations to non-owners, and owner's equity is the excess of the assets over the liabilities. So liabilities and owner's equity are essentially claims on the assets by creditors and or owners. Because stockholders own a corporation, we call the owner's equity of the corporation stockholders' equity. In turn, the stockholders' equity has two parts, paid in capital, that is the ownership claim arising from funds paid in by the owners, and retained earnings or retained income, that is the ownership claim arising from reinvestment of previous profits. And so let's walk through an example using King Hardware. So King Hardware began business as a corporation, a business organized as a separate legal entity and owned by its stockholders. The company's first transaction occurred on February 28, 20X1, when the stockholders invested a total of $100,000. So consider these following transactions of King Hardware's in March, including the initial investment by owners of $100,000. There was the acquisition of inventory for $75,000 in cash. There was the acquisition of inventory for $35,000 on account, which is a purchase. So a purchase on account allows the buyer to pay cash after the date of sale, usually within 30 days. Amounts owed to vendors for purchases on open accounts are accounts payable or liabilities of the purchasing entity. Merchandise carried in inventory at a cost of $100,000 was sold for $130,000. King Hardware received $10,000 of that $130,000 in cash and recorded accounts receivable of $120,000. Accounts receivable are amounts due from customers for sales charged to an account. They are assets of the entity. Then we have cash collections from a portion of accounts receivable from item 4 of $15,000. Transaction number 5 is a cash collection of the portion of accounts payable, cash payments of a portion of the accounts payable from item number 3. And then transaction number 6, where on March 1st, King Corporation paid $3,000 cash for store rent for March, April, and May. Rent is $1,000 a month, payable quarterly in advance beginning March 1. And so here we see these items as they are what we call journalized or entered into the accounting records for King Hardware. And the first thing we point out is that the assets total $144,000, and according to our accounting equation or the accounting identity, that has to equal the liabilities plus owner's equity of $144,000. And so if we just take these transactions and walk through them quickly, we can see that, so transaction 1, there was the acquisition of, transaction 1 was the initial investment by the owners, where they injected $100,000 in cash. So we're debiting cash because it's an asset, and assets increase with debits, and we're crediting paid in capital, which is an owner's equity account. So this double entry accounting is what it's referred to, and it says that all these items that we're recording have to equal according to the accounting equation. Item 2 is that we paid out cash of we acquired inventory for $75,000 in cash, so we paid out $75,000 in cash and we received $75,000 worth of inventory. So there's no liabilities and owner's equity impact as a result of that. We're simply crediting cash because now we're reducing cash when we pay that out, and we're adding to inventory, which is an asset, and it's increasing. So credit to cash, debit to inventory of $75,000. Item 3 was the acquisition of inventory for $35,000 on account, which created an accounts payable, which is a liability. So we're increasing inventory, which is a debit because inventory is an asset, and we're increasing accounts payable, which is we increase by credit. So we debit inventory and credit accounts payable. And so again, you see through each of these transactions that that where it crosses over between assets and liabilities and owner's equity, each transaction must balance within itself. If it's within assets solely, then it also needs to balance, and all debits must equal all credits. And so we could go through all of this, each one of these transactions, but I think it's more important that you just kind of spend time reading what the transaction is from the previous slide and then looking at what the entry is to record the transaction on the current slide. And so we have our ending balances at the bottom of the previous slide, and we had those by asset or liability and stockholders' equity account. And so if we turn that format into the balance sheet, this is what that would look like. So at the end of the period, we had cash of $27,000, accounts receivable of $105,000, inventory of $10,000, and prepaid rent of $2,000, or again the $144,000, which must equal liabilities and stockholders' equity. And so at the end of the day, we ended up with accounts payable liabilities of $15,000, the stockholders' equity of $100,000, and then we had $29,000 in retained earnings. So revenues are increases in ownership claims arising from the delivery of goods or services. We recognize revenue by formally recording it in the accounting records during the current period. We do this only after it meets two tests. First, the company must earn the revenues. That is, it must deliver the goods or render the services to customers. Secondly, the revenue must be realized or realizable. If the company collects payment, it has realized the revenue. So if the client pays the company in cash, we can realize the revenue. If it has not collected payment but is reasonably sure that it will collect the receivable, the revenue is realizable. And so here we talk about these, at the bottom here we talk about the two tests that must be met. So revenues are increases in ownership claims arising from the delivery of goods or services. We recognize revenue by formally recording it in an accounting record during the current period. We do this only after it meets these two tests. So that is that it's earned as a result of having delivered the goods or rendering the service, and that secondly, that it is realized or realizable. So if we've collected payments, we said it's what? It's realized the revenue. If it hasn't collected payment, but we're reasonably sure that it will collect the receivable, the revenue is again realizable. So expenses are decreases in ownership claims arising from delivering goods or services or using up assets. The expense in this case is cost of goods sold, the amount paid for the items sold to the customer. So we saw that where transaction 4A and 4B also illustrate the fundamental meaning of income or profits or earnings, which is the excess of revenues over expenses. So the income statement is the major link between balance sheets. Notice that each balance sheet is a snapshot at a point in time. In contrast, the income statement summarizes events during a period that caused changes in the stockholders' equity, specifically retained earnings section at the balance, in the stockholders' equity section of the balance sheet. This income statement showed that General Mills stockholders' equity or retained earnings increased by $1.8 million because of profitable operations in the year ended May 29, 2011. This $1.8 million is included in the $6.6 million of shareholders or stockholders' equity on the May 29, 2011 balance sheet. So you can think of the two sections of the balance sheet as two sides of the equation: assets equal liabilities plus owner's equity. Each separate asset, liability, or owner's equity shown on a balance sheet is an account, the term used for any item in the financial statement. The balance sheet equation highlights the link between the income statement and balance sheet. Indeed, the entire accounting system is based on the simple balance sheet equation. And again, so here it's called a balance sheet equation. We also call it the accounting equation, and other texts have called it the accounting identity. The key is assets equal liabilities plus owner's equity. And all we're doing underneath here, underneath that formula, is expanding what the definitions of these components are when we say that. So the third square down says that assets equal liabilities plus paid-in capital plus retained earnings, which are really those two components, paid-in capital and retained earnings, are really the essence of stockholders' equity. Or we can say that assets equal liabilities plus paid-in capital plus revenue minus expenses. And so the revenue minus expenses are essentially the definition of what retained income is. So we're just simply, as we move down the page, breaking out the parts of the balance sheet into a more granular form. So now let's talk about this idea of accrual basis and cash basis. There are two separate approaches to accounting, and that is the cash basis or the accrual basis. You may not realize it, but you're already familiar with the cash basis. We keep our checkbooks on a cash basis, right? We simply record the receipts and payments of cash. Many small nonprofit organizations use the cash payment basis of accounting. In contrast, corporations measure income and financial position using the accrual basis of accounting. The accrual basis recognizes the impact of transactions on the financial statements in the periods when revenues and expenses occur, instead of when the company receives or pays cash. That is, a company records revenue when it earns it, and it records expenses when it uses resources, not necessarily when cash changes hands. With the cash basis of accounting, revenue and expense recognition occurs when the company receives and pays out cash. So it's important too, earlier on we talked about this idea of generally accepted accounting principles, and we have to follow those guidelines. They provide us the basis and guidance for how we record transactions for publicly traded companies for purposes of inclusion in the key financial statements. Well, it's important to note that accrual basis is the only generally accepted accounting principle or GAAP compliant. Cash basis is not GAAP compliant. So if you're looking at financial statements that have been audited by a public accounting firm where there's been an unqualified or clean opinion on them, then you can be assured that those financial statements were issued on an accrual basis. So the major deficiency of the cash basis of accounting is that it fails to match efforts and accomplishments, that is, revenue and expenses, in a manner that properly measures economic performance. Moreover, cash basis omits key assets such as accounts receivable and prepaid rent, and key liabilities such as accounts payable from balance sheets that measure financial position. So the examples in this chapter focus on profit-seeking organizations, but nonprofit organizations such as government agencies and charitable organizations also use balance sheets and income statements. For many years, most nonprofit organizations used cash basis rather than accrual accounting. However, that's changing. As these organizations face more pressure to develop accurate measures of performance, they are increasingly using accrual accounting. The basic concepts of assets, liabilities, revenues, and expenses apply to all organizations, whatever their goals and wherever they are located. However, organizations that do not seek profits do not measure income. Further, because they have no owners, there's no owner's equity. Nevertheless, they have parallels to income statements and balance sheets. For example, balance sheets of nonprofit organizations show a category of net assets instead of owner's equity to measure the difference between assets and liabilities. Instead of an income statement, nonprofit organizations have a statement of activities that report changes in net assets. And so earlier we defined a transaction as any economic event that an accountant should record. Under accrual accounting, accountants record both explicit transactions, that is, day-to-day routine events such as credit sales, credit purchases, cash received on account, and cash payments on account. And they record implicit transactions, and those are events that day-to-day recording procedures temporarily ignore. Right? So, such as an expiration of prepaid rent or accrual of interest due to the passage of time. So explicit transactions are easy to identify because they record market transactions, exchanges of goods and services between the entity and another party. They're generally supported by source documents, clear evidence of transactions, such as sales receipts and purchase invoices. So then we talk about the types of adjustments that have to happen in order for us to correctly issue financial statements or for the balances to be correctly reflected. And we can classify these principal adjustments into 4 types. Expiration of unexpired cost, so that is something we prepaid that we have some future benefit on, and so we shouldn't expense it all in the current period. Recognition of unearned revenues, so that is where we may have been billed the client in advance and gotten paid. We wouldn't take that full amount into revenue. Accrual of unrecorded expenses, so perhaps we expect to get a bill in, we took ownership of inventory or of cost of goods sold, and but we haven't gotten a bill, so we need to accrue for the cost of those. Or accrual of unrecorded revenues, and that is so, well, we haven't been able to bill the client because we haven't delivered a product, but we've incurred costs and which are going to be reflected as current period expenses, so we need to accrue the offsetting revenue related to those. So these adjustments are all essentially a part of accrual accounting. They refine the accountant's accuracy and provide a more complete and timely measure of efforts, accomplishments, and financial positions. So you can view assets other than cash and receivables as bundles of economic services awaiting future use, prepaid or stored costs that are the accounting system carries forward into future periods. The values of assets frequently decline and eventually disappear because of the passage of time. So we have adjustment type 1 is expiration of unexpired cost. Rather than immediately charging these costs as expenses, we charge them expenses in future periods where the company uses the service. So again, we're reducing expenses where we expect to receive some future benefit as a result of the expense so that we've correctly matched the expense with the period in which the economic value was received. A good example of this is insurance. We might pay that ahead of time for 6 months or even a year, and we wouldn't want to expense all of that in the month that we paid it because we'll receive the benefit of having insurance on a monthly basis up through the period in which the policy we paid for expires. So assets frequently expire because of the passage of time. You can view assets other than cash and receivables as bundles of economic services awaiting future use. We think about that as prepaid or stored costs that the accounting system carries forward to future periods. When the company uses the services represented by a particular cost, we say the cost expires. An unexpired cost is any asset that managers expect to become an expense in the future period. So you may recall that we also talked about this idea of depreciation. So to account for long-lived assets, accountants predict the length of the asset's useful life, that is, the number of years the company expects to use the asset. We then predict any ultimate residual value, that is, the predicted value of the asset at the end of its useful life that it can be sold or disposed of. And then we spread the cost of the asset less the residual value to the years of its useful life in such a systematic way. You may recall we talked about straight line depreciation before. We talked about the MACRS, or the modified accelerated cost recovery system method of recovering the cost of the asset. And so there are different ways that we can choose to depreciate equipment, but depreciation is essentially this way of allocating the cost of equipment to, or of any asset actually, to the years of its useful life in a systematic way. And so then we have the adjustment type 2 of unearned revenue or deferred revenue. Unearned revenue really amounts to collections from customers that companies receive and record before they can earn the revenue. We get that because what happens is that sometimes, in some cases, we're able to bill the customer in advance. Suppose we've negotiated a milestone billing schedule with the customer that really is based on value delivered, and it may not necessarily tie to cost incurred. And so perhaps we could bill $1 million to the client, but we've really only incurred cost of $500,000. Well, what we don't want to do is to recognize the full $1 million in revenue if we expect that there's going to be some significant and material amount of cost yet to incur associated with the $1 million billing. And so in that case, what we do is account for this revenue, and some companies call this account advances from customers or customer deposits. Advanced collections of rent and magazine subscriptions are other examples. The third type of adjustment we talked about was with regard to the accrual of unrecorded expenses. So to accrue something means to accumulate and record a receivable or payment during a given period, even though no explicit transaction occurs. Examples of accrued expenses are expenses reported on the income statement before a company pays for them with cash, or the wages of employees for partial payroll periods, or the interest that accumulates on borrowed money before the interest is paid. And so then our final type of adjustment is this accrual of unrecorded revenues. So this represents revenue that the company has earned but has not recorded on its account, right? It's the mirror image of the accrual of unrecorded expenses, right? So we have incurred costs, we've provided services, we've met clients' expectations or provided products, and title has passed, but we haven't been able to invoice the client yet for them. In that case, we would accrue the revenue, we would credit revenue and debit the unbilled account most likely, and then when we bill the client actually, and so there we have revenue to match against the offsetting expenses that are associated with that period and with generating that revenue. Then when with the unbilled account being an asset account, and then when we bill the balance, we just are simply crediting unbilled because it's a asset account that's being reduced, and debiting billed. And so this shows this idea of accruals of expense or revenues in the columns and the timing of the accrual compared to the cash flows in the rows. So dividends are distributions of assets to stockholders that reduce retained earnings. Cash dividends, often simply called dividends, are distributions of cash to stockholders. They simply distribute assets, cash, to the owners of those assets, stockholders. They reduce both assets and owners' claims on these assets or retained earnings. The distribution is made possible by profitable operations that generate cash. Dividends reduce retained earnings, but they are not expenses like rent and wages. They do not show up on the income statement. Companies do not deduct dividends from revenues when measuring income because dividends do not help to generate sales or conduct operations. Cash dividends simply distribute assets or cash to the owners of these assets or to stockholders. Again, they reduce both assets and owners' claims on those assets through retained earnings. This distribution is made possible again by profitable operations that generate cash, because obviously we have to have cash in order to declare a dividend and pay it out. And the only way to generate cash in an organization is either to sell something that has already been paid for that results in surplus cash, or to generate cash through profitable operations. So the stockholders' equity section represents the claims of owners arising out of their initial investment, which we said earlier was reflected in paid-in capital, and subsequent profitable operations, which we said earlier was reflected in the retained earnings balances. As a company grows, the retained earnings accounts can soar if the company does not pay large dividends. Retained earnings is frequently the largest stockholder equity account, especially for older companies. Some users of financial statements have the mistaken impression that retained earnings represent a pot of cash awaiting distribution to stockholders. Rather, retained earnings and also paid-in capital is a general claim against or undivided interest in total assets, not a specific claim against cash or against any other specific particular asset. So do not confuse assets themselves with the claims of stockholders against the assets. And so here what we're talking about again is that retained earnings and paid-in capital result from profitable operations. Equity is not considered to be a pot of cash awaiting distribution. It's not. Equity is a claim against the assets of the organization, but not a claim against specific identifiable assets. So here we want to take an exercise and we want to select relevant items from a set of data and assemble them into a balance sheet and an income statement, both of which we've talked about. So using the data from the balance sheet equation in Exhibit 15-2 to prepare King Hardware's April financial statements. The balance sheet and income statements shown in Exhibits 15-4 and 15-5 are similar to those illustrated earlier. The balance sheet uses the totals at the bottom of Exhibit 15-2, and the income statement uses the revenue and expense entries in the retained earnings column. And so here we can see the balance sheet of King Hardware Company as of, and this is an important distinction, so it's as of April 30th, 20X1. And that as of is important because it says it's at a point in time, right? So this is a financial snapshot or a picture of King Hardware Company at April 30th, 20X1. And we see on the left, we have our cash, which is an asset, accounts receivable, inventory and prepaid rent, giving us total assets of $193,000. On the right, we have liabilities, accounts payable, accrued wages payable, unearned revenue, all of which are types of liabilities, and then we have stockholders' equity of paid-in capital, the initial $100,000 investment, as you recall, and then retained earnings, which is the cumulative balance of profitable operations, and that gives us $118,400 in stockholders' equity, and it necessarily must be true that liabilities plus stockholders' equity, that is $74,600 plus $118,400, must equal the total asset amount. And so here we look at the income statement for King Hardware for the month ended April 30th. And again, it's important here because we're not talking about an as of period of time as we were with the balance sheet. We're talking about for some period of time generally reflected as ending on a certain date. So this is a 1 month income statement for the 1 month period ending April 30th. So it's for the period of time, April 1 to April 30th. And we see we have sales, we have cost of goods sold to get us gross profit of $15,000. Then we have operating expenses of $1,000, wages of $6,600 to give us total operating expenses of $7,600, resulting in net income of $7,400. So this statement shows the linkage between the balance sheet and income statement. It starts with the beginning balance and adds the net income, right? This changes in retained earnings. So we have beginning retained earnings as of March 31st, 20X1. We have net income for April that we just saw on the income statement of $7,400. to give us a total retained earnings of $36,400, but we also had declared and paid out $18,000 in dividends, which we reduced from retained earnings to give us total retained earnings at April 30th, 20X1 of $18,400. And so now we want to talk about some different types of business organizations. The basic accounting concepts that we have seen before, which we've applied to corporations, also apply to sole proprietorships, which are business entities with a single owner, or to partnerships, which are organizations that join two or more individuals together as co-owners. So accounting for assets, liabilities, revenues, and expenses is identical for all forms of business. The basic concepts relating to owner's equity are also identical, except that financial statements for proprietorships and partnerships rarely make distinctions between paid-in capital and retained earnings. So let's look at an example of a comparison of owner's equity reporting. So if we look at this owner's equity section of King Hardware as of April 30th to similar presentations for a sole proprietorship and a partnership, this example shows that unlike corporations, sole proprietorships and partnerships do not distinguish between paid-in capital, that is amounts invested by owners, and retained earnings. Instead, they typically accumulate a single amount for each owner's original investment, subsequent investments, share of net income, and withdrawals. In the case of the sole proprietorship, the owner's equity consists of a loan capital account. So let's compare the owner's equity section of King Hardware April as of April 30th to similar presentations, right? And so we looked at that, right? And we can say that, again, unlike corporations, sole proprietorships and partnerships don't distinguish between paid-in capital and retained earnings. Instead, they typically accumulate a single amount for each owner's original investment, subsequent investments, share of net income, and withdrawals. So let's talk about this idea of generally accepted accounting principles, or GAAP. Accounting is commonly misunderstood as being a precise discipline that produces exact measurements of a company's financial position and performance. As a result, many individuals regard accounts as little more than mechanical tabulators who grind out financial reports after processing an imposing amount of detail in accordance with stringent predetermined rules. Although accountants take methodological steps with masses of data, their rules of measurement allow much room for judgment. These judgments are guided by a set of principles on which there is general agreement, not on rules that can be proved. We call the principles and procedures that together make up accepted accounting practice at any given point in time generally accepted accounting principles, or GAAP. An audit is an examination or in-depth inspection of financial statements and company's records made by the independent public accounting firm in accordance with auditing standards approved by the Public Company Accounting Oversight Board in the United States. The Public Company Accounting Oversight Board, or PCAOB, is a part of the Securities and Exchange Commission, or SEC, which is a government agency that regulates U.S. financial markets, including financial reporting. After auditing a company, an accounting firm issues an independent opinion, that is the accountant's assurance that management's financial statements are in conformity with GAAP. And if they're not, then they either need to be changed so that they are, so that this opinion can be issued, or an adverse opinion could be issued that says they're not in conformance with GAAP, which would be a problem for the company. The auditing firm may disclaim an opinion that says we can't say that they are, we can't say that they aren't, we can't issue an opinion on them, which becomes a problem for the company. So there are multiple different types of audit opinions. And again, if you're interested in audit, the VIU offers a good course in auditing that I think you would find useful and helpful if you're interested in pursuing accounting as a discipline or a major. So auditors and the investing public rely on GAAP determined by the Financial Accounting Standards Board, or FASB, in the United States, and the International Accounting Standards Board, or the IASB, in much of the rest of the world. The FASB, consisting of 7 full-time members plus a staff of nearly 60 members, is an independent creation of the private sector. Its mission is to establish and improve standards of financial accounting and reporting for the guidance and education of the public, including issuers, auditors, and users of financial information. The International Accounting Standards Board is a similar independent organization whose pronouncements, called International Financial Reporting Standards, or IFARs, define GAAP in the European Union and more than 100 other countries. And right now what we see is a move to try to merge these different GAAP and IFARs, particularly in light of the increased globalization that is going on in the world. So in 2008, the SEC started accepting financial statements based on IFARs for non-U.S. companies whose stock is traded in the U.S. capital markets. It also defined a roadmap for eventual adoption of international standards by U.S. companies as well. The FASB and IASB are currently working on converging their separate standards into one set of worldwide standards. And this is a very complicated, drawn-out, complex problem that's been worked on for many years, and there's still a long way to go with it. So the SEC has the ultimate responsibility for specifying GAAP for U.S. companies with publicly traded stock. However, the SEC has informally delegated much rule-making power to the FASB. Even when the pending move to the international standards occurs, such power will also be delegated to the IASB. So regardless of what the accounting standards say, they do no good if accountants fail to follow them. A hallmark of the accounting profession has been its ethics and integrity. Most accountants and auditors are highly ethical and truthfully report their financial results in accordance with GAAP. The media have feasted on few recent allegations of untruthful reporting in companies such as Washington Mutual, AIG, and Freddie Mac, but these are exceptions. Confidence in financial information is important to the smooth functioning of the world's capital markets, and confidence in financial statements depend on the competence and integrity of accountants and auditors. So we have, GAAP says that in the United States, is based on a conceptual framework that the FASB established in the 1970s. Among the most important concepts are 3 broad measures or valuation principles that underlie accrual accounting, and that is recognition, or when to record revenue, matching and cost recovery, that is when to record expense, and we call this the matching principle, and the stable monetary unit, so what unit of measure to use. And we'll talk about each of these 3 measurement conventions next. The first principle on recognition, which is introduced in the text on page 622, specifies when a company should record revenue in the accounting records. We indicated that companies recognize revenue when it is both earned and realized or realizable. Consequently, most companies recognize revenue when they deliver goods or services to customers. However, in some industries, revenue recognition is not so straightforward. The timing of revenue recognition is important because it leads to the recording of expenses through the concept of matching. The linking of revenue as measured by the selling prices of goods and services delivered with the expenses incurred to generate them as measured by the cost of goods and services used. Accountants apply the matching principle as follows. We identify the revenue recognized during the period. We record expenses that relate directly to the recognized revenue, such as sales, commissions, or cost of goods sold, and then we record expenses that are cost of operations during a specific time period that have no measurable benefit for a future period and thus must be linked to the current period's revenues. Examples of these are administrative salaries or wages of janitors and cost of supplies used. So essentially the matching principle says that we associate revenues with expenses in both ways. If revenues are generated, we match the expenses associated with generating that revenue. If expenses are generated, we match them with revenues that those expenses generated, or we match those with revenues of a specific time period if there is no future benefit to be received as a result of the incurrence of that expense. So the heart of recognizing expense is the cost recovery concept, right? That is, companies carry forward in assets such items as inventories, prepayments, and equipment, and that is because they expect to recover the cost of these assets in the form of the monetary unit. For example, the United States dollar, or the yen in Japan, or the euro in the European Union, is the principal means for measuring assets, liabilities, and stockholders' equity. It is the common denominator for quantifying the effects of a wide variety of transactions. And so now we're going to talk about the Appendix 15A, where we describe several concepts that are preeminent parts of the body of GAAP. And so this is this idea of continuity or going concern, the idea of relevance, the idea of predictive value, confirmatory value, faithful representation, comparability, consistency, verifiability, timeliness, understandability, materiality, conservatism, and cost benefit. And all of these terms have important meanings in the accounting profession, so I encourage you to go into Appendix 15A and become familiar with these terms and what they mean. And then finally we talk about Appendix 15B, where we're talking about ledger accounts, and this appendix focuses on some of the main techniques that accountants use to record the transactions that we talked about in the chapter, and that deals with T accounts, where we have debits and credits. We talk about ledger accounts. We have this idea of double entry system, where all debits must equal credits, and that there should be no total amount of a journal entry after you've offset debits and credits should be zero. And then we talk about debits and credits. So again, I encourage you to look in Appendix 15B with respect to how ledger accounts come into the accounting mix. And so that concludes Chapter 15. It was a little bit of a longer lecture, but there's a lot of meat in Chapter 15 because it really deals and covers a lot of different areas in accounting conventions. So please go back and reread this very important chapter and then proceed to the discussion forums.